Pay down real estate or buy more? More often than not, most investment decisions come down to the level of risk that you're willing to take. So in this case, there's a high risk and a low risk option. The low risk option is to simply pay down your mortgage. And no one can tell you that paying down your mortgage is a bad idea. It's a good idea. And if you wanted to live in your own house for the rest of your life and you wanted to continue paying down that mortgage and you wanted to end up paying off the mortgage and continue living in that house mortgage free, then that is an excellent plan for the rest of your life. No one can tell you that that's a bad idea. The higher risk option is to buy more real estate, in which case you don't want to put the money that you have in your savings account into your mortgage because it becomes difficult to take it back out. So if you put the money that you have into your mortgage, it pays down the principal and you're only paying interest on the amount that you have mortgaged out. So if you have a $200,000 mortgage and your mortgage payment is due in 2 days, you pay your mortgage payment, you pay a little bit of principal down, and now you're only paying interest on $199,500. So you're paying interest on $500 less, which is less interest. That's why your payment changes slightly every single month. The amount that you pay stays the same, but the difference between interest and principal changes just slightly. So if you have a very high interest rate, I would recommend paying down your mortgage or even refinancing before you start buying more real estate. Any high interest rate would be over 5%. Lower than 5%, I would say keep it. Invest in more real estate by saving money into your savings account, and once you have enough of a down payment to put a down payment on a new place, then do that. Sometimes you can put less of a down payment down if you move into the new place. So if you're already living in a house with your family and everybody agrees that moving into a new house is going to be just fine, then move into the new house with your down payment and you can do maybe 5% down even on a second property, and then you can rent out the old house. So the investment cash flow would be based on the amount that you put down on the new house, and then you would be trying to make 10% on the money that you put down on the new house. So buying more real estate and continuing to leverage is the word if you wanted to Google that and start looking it up. Leveraging your real estate, if you have 5 properties and you paid them all off, 100% paid off, you're collecting the rental income and you might think, hey great, I'm making rental income and I don't have a payment, so I'm making even more money. But that's not always the case. A lot of times, if you have a $100,000 condo and you're making rent and the only thing you have is a condo fee and taxes, and you are making a lot more money, but is that money that you're making per year 10% on the $100,000? So you'd have to be making $10,000 per year on your $100,000 that's invested in that house. So what happens is a lot of investors will buy more by leveraging 80% of each one of those houses or condos and then taking that money and buying more. So as you put down, if you put down 20% on a condo today and you rent it out for 5 years, during those 5 years your payment is going to bring your mortgage from 80% down to maybe 75% of whatever it started at. And then what happens is a lot of investors will take that extra 5% as a home equity loan back out of the property, and then they will put it into a down payment for a new property. So that's how you would leverage the stuff that you have into buying more property. And essentially all you're doing is saving anyway. So you can either put all of your money into your mortgage and continue paying it down really fast, and you get down to 50%. You have a $150,000 mortgage and you owe and your house is worth $300,000, then you could leverage up quite a bit. You could go up to 240 because 80% of 300,000 is 240. So you could essentially take out $90,000 from that property as a home equity loan. Wait a few months, and then once you wait a few months, then you can get approved for a new mortgage using that as a down payment, and it's completely fine. You can definitely do that. So the choice is really up to you and how much risk you want to take. It's almost like saying, is it better to buy Disney or McDonald's stock, or is it better to buy Google or Facebook? No one can really tell you it's better to buy the big difference between a technology company that's only been in business for 20 years compared to staple companies like Disney and McDonald's that have been in business forever. You may not make as much money, you may not get as much growth out of the stock, but the risk level is much lower that McDonald's is going to go out of business tomorrow than Facebook or Google, because they just haven't been in business as long. There's no telling how long those companies can really stay in business. All the things going on in the world, the depressions and recessions over the years, world crises, and all kinds of different things that have happened over the years. McDonald's, Coca-Cola, Disney have made it through all of those struggles over the years, all of the different things that have gone on. And when you think about that, you know, some of these technology companies may not make it. So it's not a bad investment to hold those companies, it's just more risky. So all of these things come down to your risk level. So continue to think about that. And you know, if you're only willing to put your money in the savings account, then that's all you're willing to do. If all you're willing to do is pay down your mortgage, then that's a great idea. You won't pay interest on that money anymore, so it's a good idea to pay off your credit cards and pay off your mortgage. But other people are much more risky, and they're going to rack up debt on their credit cards so that they can put cash in their savings account, only pay the minimum payment. Take a personal loan out. Get a home equity loan up to 80% of your home's value. Collect all that cash and then put it down on a new property. And of course, that's incredibly risky, but because if something happens, if you don't get a tenant in the first couple of months, then things can really happen. So if you want to wait until you have $20,000 in your account before you spend 15 on a property so that you keep that extra buffer there, those little things just limit the amount of risk that you end up taking. So if you're able to save $10,000, then you're able to save 15 too. It's just going to take a little bit longer. So set that buffer for yourself, whatever you feel comfortable with. And once you have that buffer set and you reach your goal, then start looking at properties. And you know, you can continue looking at properties the entire time throughout the process. It can get a little, you know, frustrating to not be able to make an offer when you save $6 out of $10,000, but as you save that money, you'll start to see how the market is going. The market might be going up or down. And then whenever you invest that money, cash flow is going to tell you if you're making enough money. Is it a good deal? Is it not a good deal? I have other videos that talk about whether real estate is or isn't a good deal. And the point is that if you invest $10,000 and you make $1,000 per year, then you're making 10%. If you invest $20,000 and you're making $2,000 per year, you're making 20%, 10%. So if you can make 10% and then you look at compounding interest over the next 30 years, you're going to compound your interest and you're going to double your money every 7.2 years just by making 10%. So if you find a deal where you can buy a property for $10,000 and you look at the rental income that you can get in that area and you look at all of your expenses and you realize that you can make $100 per month, then you invested $10,000, you're making $100 per month, which is $1,200 per year, and that's 12% on your money. So that's a great deal. I don't care what the property is selling for, I don't care what is going on. If you put down 5% on a property, which is $10,000, and you add up all of your costs and you have income coming in of more than 10% of that money, you have a good deal. So a lot of people might say that 300,000, it's not worth it, you should only offer 290, or 290 is not worth it, the market's going to come down over the next 6 months, make sure you wait to buy. Don't listen to that. Look at how much you're putting into it, because that makes a huge difference. A deal on a $300,000 house, two people might consider the deal completely different. A $300,000 house, buying it in cash, means you have to make $30,000 per year on your money. $300,000 only putting down 5% means you only have to make your $15,000 investment, you have to make $1,500 per year. So that's a big difference. Your risk level, how much money you're putting down, and is it a good deal based on making 10% on the money that you invested. If you can't make 10%, you might as well just leave your money in an IRA. You might as well leave it in an index fund. It's a lot less work than owning real estate. You don't have to find tenants. You don't have to be careful about which tenants you put in and which ones you don't. You don't have to worry about having money in a savings account to worry about fix-up costs here and there. You have to make more than 10%. If you're not making more than 10, it's not worth pulling the money away from an index fund, which is the easiest thing to manage. I'm currently doing a little bit of a mix between the two. Like I said, I'm not going to force people, I'm not going to tell people that it's better to pay down your mortgage than it is to buy more real estate. I'm not going to tell people that it's better to buy more real estate than it is to pay down your mortgage. It's about your risk level, and I'm right in between there. I like to have a very nice buffer. I have a family, I have a wife and a child, and I like to keep things safe. But I also like to invest. I'm not just going to put money in a savings account and let it become worth less and less and less over the years because of inflation. So I want to invest my money. I just want to make sure that I do it in a very safe manner. So what I do is I wait for it. I don't leverage out the money. I just continue making my income, and as I put it into my bank, I end up using it to buy more property. I talk to my bank, I talk to my lender, and I say, I already have this many properties. I'm looking to buy another one. Am I being forced to put down 20%, or is there any way that I can put down less? Once I figure out how much money I have to put down as a percentage, then I start looking into the different houses on the market, and I find a good deal based on how much I'm going to invest and if I'm going to make more than 10%. And to be honest, I like to make 15%. It can be difficult if you're not used to running that formula, but once you run the formula a few times, it's so simple. The rent minus the mortgage payment, minus the taxes, minus a condo fee if there is one, and insurance. The tenant pays the rest of the stuff, and you can even account for a little bit of maintenance, but you're going to be saving that money as maintenance costs. And if the maintenance comes up, then pay for the maintenance. No big deal. Like I said, keep that buffer for yourself and make sure that you're not taking every last dollar that you have and putting it in on something that you're trying to invest on. It's not worth buying a second house and struggling to own a second house. It doesn't make sense. So if it's going to cost you $6,000 or $7,000 to buy that house and pay for the closing costs, then you want to save $8,000 or $9,000 so that you can have that extra buffer in case it takes 2 months to get a good tenant in there. You don't want to make a bad decision on a tenant just because you have to get a tenant in there on the first day. You want to make sure that you have your money set aside, you have a good savings account, a good reserve. And the bigger the reserve, the more safe you want to be. So if you want to increase that risk, don't save any money. Just rack up a credit card, get a personal loan, wait a couple of months, and then use it. I say wait a couple of months because your lender or your bank will always ask you for 2 months worth of checking and savings account statements. So if you have a $10,000 deposit into your savings account because of getting a personal loan or leveraging one of your properties and pulling a big amount of money into your account, then they're going to see that, they're going to wonder where it came from, and banks do not like to see that you're using a loan to leverage a new property. So just leave it for a couple of months, and once you have clean statements, then you're able to just kind of say, hey, I got a personal loan a while ago, it's no big deal, I'm just using the money in my savings account. And when you show your account statements, it's not going to show that you just deposited something into one of your accounts. Thank you.